Kevin O'Leary loves to say your $5 latte is the reason you're not a millionaire. And for a long time, people nodded along like it was gospel. But in 2026, that advice is not just outdated, it's dangerous. Because if you're still broke today, it's not the coffee, it's not Netflix, it's not avocado toast. It's the fact that you have no strategy for money once it touches your hands. Let's be brutally honest. You don't stay poor because you spend $5. You stay poor because you don't know where to deploy your first 100. Saving pennies does not create wealth. Directing capital does. A disciplined saver with no strategy stays poor longer. A reckless spender with a lethal strategy gets rich faster. And here's the uncomfortable truth nobody tells you. Most people don't actually have a money problem. They have a decision problem. They don't know where money should go first. So it leaks everywhere. They save with no upside. They invest with no edge. They hustle with no leverage. And then they wonder why nothing compounds. Let me shatter a myth right now. The first $100 is not about profit. It's about positioning. Because $100 doesn't buy freedom. It buys access. Access to skills. Access to distribution. Access to attention. Access to leverage. And if you waste that first $100 on comfort instead of positioning, you lock yourself into the same income loop for another year. That's why two people can earn the same salary. One escapes the system, and the other stays trapped forever. Same income, different deployment. Kevin O'Leary is right about one thing: poor habits compound against you. But he's wrong about the villain. The villain isn't the lie. The villain is directionless money. In 2026, the game is not about cutting expenses. It's about aiming them like weapons. If you don't know where your next $100 should go to increase your future income, you are not early. You are late. Because right now, people are flipping $100 into skills, audiences, tools, and systems that print cash quietly, while everyone else argues about coffee. And if you're still trying to save your way to wealth, you're playing defense in a game that only rewards offense. In the next few minutes, I'm going to show you exactly how money actually grows now, where that first $100 should go, and why most people will never escape. Not because they're broke, but because they never learned how to deploy. Kevin O'Leary gives advice from the mountaintop, not from where you're standing right now. And that distinction matters more than people realize. When a multi-millionaire tells you don't spend, he's speaking as someone who already owns income-producing assets, brand equity, deal flow, and leverage. His money is already working while he sleeps. Yours isn't. So when you copy his advice without his contest, you make a fatal mistake. You adopt scarcity behavior in a world that rewards capital aggression. Here's the uncomfortable truth. Being cheap is not an investment strategy. Saving money is defensive. Wealth is built offensively. For someone like Kevin O'Leary, every dollar not spent is still earning somewhere else. Dividends, royalties, equity, licensing. For you, every dollar not deployed is idle, and idle money quietly dies. Inflation doesn't announce itself. It doesn't knock. It erodes. If you take your $100 and hide it in a jar by December 2026, that money doesn't just sit there. It shrinks. Same number. Less power, less reach, less future. That's not discipline. That's decay. Celebrity advice sounds smart because it's simple. Spend less, cut expenses, stop buying lats. But simplicity without context becomes poison. Because what they don't tell you is this: they are not saving to get rich. They are saving because they are already rich. Their restraint protects assets. Your restraint delays escape. And here's where people get trapped. They confuse frugality with progress. They feel productive because they're cutting back, but nothing in their life is expanding. No new skills, no new income streams, no leverage, just tighter budgets and longer timelines. That's the danger. When you obsess over not losing money instead of learning how to multiply it, you lock yourself into a defensive mindset. And defense never wins championships. It just helps you lose slower. The wealthy don't worship cash. They use it. They deploy money to buy time, knowledge, reach, and positioning. They understand that a dollar spent correctly returns with friends. So when a celebrity tells you to stop spending, what they really mean, but never say, is stop wasting money on things that don't multiply. But if you hear only don't spend, you'll protect $100 so hard that it never grows into $1,000. And that's how good advice, given from the wrong altitude, keeps people stuck. Because in 2026, money that isn't moving with intention is already falling behind. Here's the brutal truth nobody wants to say out loud. You are not poor because you don't earn enough. You are poor because you treat money like a reward instead of a tool. That's the real divide, not income, not luck, not background, behavior. Take the same $100 and put it in two different hands. The poor mindset looks at that $100 and asks, what can I buy right now to feel good? So it turns into shoes, clothes, a phone upgrade, a night out, and 2 years later, that $100 is worth maybe $10, if anything at all. Not because those things are evil, but because they die the moment you buy them. The rich mindset looks at the same $100 and asks a complete different question. How can this come back with friends? That $100 becomes a skill, a tool, a small system, access to something that produces cash, leverage, or reach. And even if it fails forward. It teaches. It compounds experience. It sharpens judgment. That's why the poor get poorer slowly and the rich get richer quietly. Because one side spends money once, the other spends money forever. And here's the part that should sting. You already know this, but you keep ignoring it. You tell yourself, I'll start investing when I have more money. I'll build something once I'm stable. I just need a better month. That sentence, once I have enough, is the poverty trap. Enough never arrives before action. It arrives because of it. Waiting for more money before you start is like waiting to get fit before going to the gym. It sounds logical, but it guarantees nothing changes. $100 is not too little. It's the test. Because if you can't deploy $100 intelligently, you won't deploy $10,000 any better. More money doesn't fix bad strategy. It magnifies it. This is where people get it twisted. They think rich people invest because they're rich. Wrong. They're rich because they invested when it felt uncomfortable, early and small. The poor mindset wants certainty. The rich mindset understands probability. Poor want guarantees. The rich want asymmetry. Meaning, small downside, massive upside. Shoes have zero upside. Skills do. Entertainment depreciates. Assets don't have to. And assets aren't just stocks or real estate. An asset is anything that pays you back with money, time, or leverage. A skill that increases your income is an asset. An audience is an asset. A tool that helps you sell faster is an asset. And here's the warning you need to hear. Clearly, the biggest mistake you're making right now is waiting for confidence, waiting for clarity, waiting for a bigger bank balance. While you wait, inflation eats, technology moves, opportunities close, and the people who started with less than you quietly pass you. In 2026, the game rewards early deployment, not perfect conditions. You don't need more money. You need a different relationship with the money you already touch. Because the difference between poor and rich isn't intelligence. It's not hustle. It's not even discipline. It's this. One spends to look rich. The other spends to become rich. And once you see that, you can't unsee it. Every $100 becomes a decision point. A fork in the road, comfort or compounding. Let's get one thing straight before we go any further. This is not gambling. This is not get rich quick. This is not some TikTok fantasy where $100 magically becomes a Lamborghini. This is a deployment strategy. The exact way intelligent people use small money to build momentum in 2026. Because here's the truth nobody likes to admit: if you don't know what to do with $100, you don't deserve $10,000 yet. Money is a responsibility before it is a reward. So we're going to break this down ruthlessly, logically, and without emotion. 3 buckets, 3 purposes, 3 different time horizons. This is how professionals think. This is how capital survives, grows, and compounds. First, you do not put all $100 in one place. That's amateur behavior. Second, you do not chase dopamine. That's poverty behavior. Third, you do not wait. That's fear disguised as patience. You allocate. The first $40 goes into your safe base. This is where most people either overthink or completely screw it up. They hear index fund and their brain shuts off because it doesn't sound exciting. Good. It's not supposed to be exciting. It's supposed to be reliable. Index funds exist for one reason, to give you exposure to the economic engine without you having to be smart every day. Funds like VU or VTI aren't bets on one company. They're bets on the system itself. The S&P 500 doesn't need you to time it. It doesn't care about your feelings. It just absorbs productivity, innovation, inflation, and growth over time. This $40 is not there to impress you. It's there to anchor you. It teaches you the most important lesson in investing. Consistency beats brilliance. Most beginners make one of two mistakes. They either avoid the market because they think $40 is too small, to matter, or they put everything into one risky play hoping for a miracle. Both are wrong. That $40 does three critical things. It gets you in the game. It builds the habit of investing. And it protects you from your own stupidity later. Because once you've tasted volatility, once you've watched markets go up and down without panicking, you're no longer fragile. You stop reacting emotionally. You start thinking in years instead of days. This is your defensive capital. It's not flashy. It's not fast. But it compounds quietly while you're busy building a fence. Now let's talk about the second $30, because this is where people either level up or expose themselves. This goes into 2026 tech and AI. Not hype, not memes, not someone on Twitter said. Real companies, real infrastructure, real future leverage. You are not trying to pick the next unicorn. You are trying to position yourself in the direction the world is already moving. Artificial intelligence, automation, data infrastructure, cloud computing. These are not trends. They are rewiring the global economy. And here's the key point. You don't need thousands of dollars anymore. Fractional shares exist. That changed everything. You can own a piece of companies building chips, models, platforms, and infrastructure with $5, $10, $10, $15 at a time. That's not insignificant. That's access. This $30 is asymmetric capital, meaning limited downside, uncapped upside. If it goes nowhere, you lose $30 and gain experience. If it grows, it introduces you to compounding on a different level. But here's the rule most people violate. You do not chase. You position. You're not buying because something is trending today. You're buying because it will matter 5 years from now. This money is not for daily checking. If you're refreshing price every hour, you're doing it wrong. This is long-term exposure to future productivity. And psychologically, this bucket does something powerful. It rewires how you think about technology. You stop seeing AI as something happening to you and start seeing it as something you're aligned with. That mindset shift alone is worth the $30. Now comes the most important part, and the one people consistently undervalue because it doesn't feel like investing. The final $30 goes into you. Self-education, tools, skill acquisition. This is the highest ROI bucket by a mile, and it's not even close. Markets can go sideways, stocks can stall, but a skill that increases your income follows you everywhere. In 2026, the best investment is not a ticker symbol. It's leverage inside your own brain. A book that teaches you sales, copywriting, negotiation, analytics systems, or distribution can return more than any stock ever will if you apply it. A specialized tool that helps you create faster, sell better, automate, or analyze is not an expense. It's a multiplier. And this is where most people expose their real problem. They'll invest $30 into a stock without blinking, but hesitate to invest $30 into learning how money actually works, that's backwards. Because stocks don't create income. Skills do. Skills increase your earning power. Earning power increases capital. Capital accelerates investing. This is the loop. When you invest in yourself, you're not chasing returns. You're expanding capacity. And capacity is what separates people who stay stuck from people who scale. Here's the key distinction you need to understand deeply. The first $100 is not about returns, it's about identity. You are teaching yourself, I deploy money intentionally. I think in systems. I invest before I feel ready. That identity compounds faster than money ever will. Most people sabotage themselves because they wait for confidence. But confidence is built by action, not before it. This blueprint does something dangerous in a good way. It removes excuses. You can't say you don't have enough money. You can't say you don't know where to start. You can't say the system is rigged against you, because $100 is enough to begin positioning. Now let's address the fear that's probably sitting in your chest right now. What if I lose it? Good. That fear is normal. It means the money matters to you. But here's the truth. If losing $100 would destroy you, staying exactly where you are will destroy you slowly. The goal is not to avoid loss. The goal is to avoid stagnation. Stagnation is the real killer. It's silent. It feels safe. And it keeps you exactly where you are while the world moves forward without you. This blueprint isn't sexy. It's not loud. It doesn't promise miracles. It promises momentum. And momentum is what changes trajectories. Once you've deployed your first $100 correctly, the next $100 becomes easier. Then the next. Then the numbers grow, but the thinking stays the same. You're no longer guessing. You're allocating. You're no longer reacting. You're positioning. That's how people quietly escape financial gravity. Not by saving harder, not by dreaming louder, by learning how to aim money with intention. In 2026, wealth doesn't belong to the smartest or the luckiest. It belongs to those who deploy early, learn fast, and compound relentlessly. And it starts exactly here. Not with more money, but with better decisions. $100 is not too small. It's the doorway. What matters is whether you walk through it. Before you put another dollar to work in 2026, you need to hear this part clearly, because one bad decision can erase 10 good ones. If you want to build wealth, you don't just need to know what to buy. You need to know what to stay away from. Because the market isn't just full of opportunities, it's full of traps. Trap number one, fast fashion and hype clothes. This is the quiet killer of young money. You buy it because it feels like status. You justify it because it wasn't that expensive. And the moment you swipe your card, it's worth almost nothing. Clothes are not assets. They are depreciating signals. That $100 hoodie doesn't become vintage. It becomes outdated. In 2 years, it's either at the bottom of your closet or donated, while the money you could have deployed is gone forever. Fast fashion doesn't just steal your cash. It trains your brain to trade future leverage for present validation. And that mindset is expensive. Trap number two, new cars bought on debt. This one feels adult, responsible, even successful. It's not. A new car loses value the second you drive it off the lot. Then interest piles on top like a tax for impatience. You're not buying transportation. You're buying negative compounding. Monthly payments shrink your options. Insurance drains cash flow. Maintenance eats flexibility. And worst of all, debt locks you into a fixed future while your income is still uncertain. A car should support your life, not chain it down. If you need a car, buy reliability, not ego. Because wealth is built by people who keep their cash mobile, not tied up in metal that rusts. Trap number three, get rich quick, crypto schemes. Let's be precise here. This is not anti-crypto. This is anti-delusion. Meme coins with no utility, no revenue, no roadmap, and no real users are not investments. They are lotteries dressed as technology. They spike because of hype, not value. They crash because there's nothing underneath. If the only reason something is going up is because more people are buying it, you are not early. your exit liquidity. Real innovation survives without noise. Scams require constant attention. If you don't understand exactly how a project creates value, captures value, and distributes value, stay out. In 2026, money moves faster than ever, but stupidity moves faster. The pattern is always the same: easy promise, urgent tone, fake scarcity. And the result is always the same too: someone gets rich, and it's not you. Here's the rule that will save you money for the rest of your life. If it feels exciting before it makes money, it's probably designed to take your money. Wealth is quiet. Traps are loud. Avoid these three, and you don't just protect your $100, you protect your future. Because what you don't buy is just as important as what you do. Let me leave you with a challenge. Not motivation, not hype, not empty hope. A decision. Because 2026 is not going to reward effort. It's going to reward positioning. This is the year where the gap widens, where people who deploy early learn fast and move with intention quietly pull away, while everyone else keeps waiting for permission. And that's why you need to hear this clearly. Stop listening to billionaires who forgot what it feels like to have nothing. They talk about discipline from a place of abundance. They talk about patience while their money compounds automatically. You don't need their restraint. You need your first foothold. You don't need perfect timing. You don't need a windfall. You don't need another year of preparing. You need to start. $100 today, deployed with intention, beats $10,000 someday sitting in your imagination. This is not about becoming rich overnight. It's about becoming unstuck. Because once you deploy your first $100, something changes. You stop watching from the sidelines. You stop consuming and start participating. You stop hoping and start learning in real time. That shift alone puts you ahead of most people. The people who win in 2026 won't be louder. They won't be luckier. They'll just be earlier and consistent. They'll understand that wealth isn't built by cutting everything out of your life. It's built by aiming money toward growth instead of comfort. So here's the challenge. This month, not next quarter, not when you feel ready, deploy your first $100 using the blueprint you just learned. Build the habit, build the identity, build the momentum, and then stack it. If you're serious, not curious, not entertained, but serious, comment start below. Not for me, for you. It's a public line in the sand, a signal that you're done waiting and done drifting. And if you want to stay ahead in 2026, not with noise, but with clarity, subscribe to this channel. Every week, we break down what actually builds wealth in this new economy. No celebrity fluff, no fantasy plays, just strategy, systems, and execution. 2026 is going to be the year of the smart investor. The only question left is simple. Are you starting, or are you watching others do it?